Major shift may be developing inside the U.S. financial system, and if it continues, the people who already own assets could benefit far more than people who depend almost entirely on wages. The Federal Reserve is at the center of that shift. At its latest meeting, the Fed kept its policy rate around 3.7% instead of raising rates again. That decision was important because inflation remained elevated and many investors expected the Fed to respond more aggressively. But something unusual happened immediately afterward. Instead of long-term borrowing costs falling, Treasury yields moved higher. The 10-year Treasury yield jumped from around 4.4% toward 4.8%, and the 30-year Treasury showed a similar reaction. That may not sound dramatic, but the U.S. government is financing tens of trillions of dollars of debt. When borrowing costs rise even slightly across that amount of debt, the eventual impact can reach hundreds of billions of dollars. So even though the Federal Reserve did not officially raise its policy rate, the bond market effectively tightened financial conditions on its own. This highlights an important distinction. The Fed directly controls short-term interest rates. It does not completely control the yield investors demand to lend money to the government for 10, 20, or 30 years. Those yields are set in the bond market. And increasingly, the bond market appears willing to challenge the Fed. One reason may be a change in how the central bank communicates with investors. For years, markets became heavily dependent on forward guidance. Fed officials would explain how they expected inflation, employment, and interest rates to develop. Investors would then price those expectations into stocks, bonds, currencies, mortgages, and other assets. The Fed was not simply setting today's rate. It was constantly influencing expectations about tomorrow's rate. That became especially important after the 2008 financial crisis, when government debt expanded and the Federal Reserve became much more involved in financial markets. But the current direction appears different. The Fed is signaling that markets may need to do more of the price discovery themselves rather than depending on constant promises about future interest rates. That makes investors nervous because the largest borrower in that supposedly free market is the United States government, and the federal government is carrying an enormous debt load. If investors become less confident about inflation, deficits, or the government's future financing needs, they can demand higher yields regardless of what the Fed wants. That is exactly what appears to be happening. The second major issue is inflation. Fed leadership has suggested that policymakers should look beyond one single inflation statistic and focus more broadly on the underlying trend. There is a reasonable argument behind that. Not every increase in prices comes from excessive consumer demand. Sometimes inflation rises because oil prices spike. Sometimes wars disrupt supply chains. Sometimes food or energy prices jump temporarily. Central banks often try to look through those short-term shocks rather than dramatically changing monetary policy every time one volatile category moves. But this creates another problem. Bond investors care about real returns. If a treasury yields 5% while inflation is 2%, the investor earns roughly 3% after inflation. But if that same bond yields 5% while inflation is actually running at 5%, the investor is barely preserving purchasing power. So if investors begin believing that official inflation measurements are understating the actual loss of purchasing power, they will demand higher yields. That could explain why long-term treasury rates remain elevated, even when the Fed itself does not raise rates. This leads directly into the concept of fiscal dominance. In theory, the Federal Reserve is independent. Its job is to control inflation and support employment. It is not supposed to set monetary policy simply to make it easier for the federal government to borrow money. But that becomes increasingly difficult when government debt grows large enough. The higher the debt, the more sensitive the federal budget becomes to interest rates. A government carrying $5 trillion in debt can absorb a rise in rates much more easily than a government carrying around $40 trillion. Eventually, the cost of servicing the debt starts competing with everything else the government wants to spend money on, and that pressure is already increasing. One of the problems is that some of America's largest historical creditors have less incentive to keep accumulating Treasury securities. Japan is one example. For decades, Japanese investors bought enormous quantities of U.S. government debt partly because interest rates in Japan were extremely low. But Japanese yields have been rising. If Japanese investors can earn increasingly attractive returns at home, they have less reason to take currency risk by sending capital to the United States. That does not mean Japan suddenly sells every treasury it owns. A more realistic scenario is that some securities mature and the money is simply not reinvested at the same pace. That still forces the United States to find another buyer. China creates another challenge. China was once one of the most aggressive accumulators of U.S. government debt, but relations between the two countries have changed dramatically. Tariffs have increased. Technology restrictions have expanded. Sanctions have become more important. Competition over artificial intelligence, semiconductors, manufacturing, and global influence has intensified. Under those conditions, China has less incentive to keep a huge portion of its reserves concentrated in American government debt. Again, this does not require China to dump everything overnight. Gradual diversification is enough to matter. If Japan buys less and China buys less, while the United States issues more debt, someone else has to absorb the difference. And the amount of debt needing financing continues to grow. The exact future number will depend on government spending, tax revenues, economic growth, recessions, wars, and other factors. But the direction is what matters. The government continues borrowing enormous amounts of money, and every new Treasury security requires a buyer. If there are not enough buyers at a 3% yield, the yield moves to 4%. If there are not enough buyers at 4%, it moves toward 5%. The market keeps adjusting until the return is attractive enough. That creates another problem: interest expense. Federal interest payments have already risen dramatically compared with where they stood only a few years ago, and the refinancing cycle could make that much worse. A large amount of government debt was issued between 2008 and the early 2020s when interest rates were extremely low. Some of that debt carries rates of only 1%, 2%, or 3%. But Treasury securities eventually mature. When they do, the government usually does not eliminate the debt, it refinances it. Old low-rate debt gets replaced with new debt carrying today's much higher rates. That means the government can owe roughly the same principal, but pay dramatically more interest. Multiply that across trillions of dollars and the annual interest bill can rise very quickly. This creates a dangerous feedback loop. Higher debt creates higher interest expense. Higher interest expense increases the deficit. A larger deficit requires more borrowing. More borrowing increases the supply of treasuries. And if investors demand higher yields to absorb that supply, interest expenses rise again. That is where fiscal dominance becomes a serious concern. The Federal Reserve could eventually face a conflict between protecting the purchasing power of the dollar and protecting the financial system from the consequences of extremely high government borrowing costs. Keeping rates high may help fight inflation. But it also makes federal debt more expensive to refinance. Lowering rates may reduce financial pressure. But doing so while inflation remains elevated could weaken the dollar's purchasing power even further. Government support programs expand. Unemployment spending rises. Stimulus measures may be introduced. The government borrows even more, so projections based on relatively stable conditions can deteriorate rapidly when something goes wrong. That is why the debt problem matters directly to ordinary people. Government interest payments ultimately compete with other federal priorities. Money spent servicing debt cannot simultaneously be spent on infrastructure, healthcare, defense, social security, or other programs without additional borrowing or taxation. As interest expense consumes a larger portion of federal revenue, the political choices become increasingly difficult. And this is where the discussion moves from government finance into personal wealth. If policymakers eventually tolerate more inflation because the alternative is an increasingly painful debt crisis, asset prices could behave very differently from wages. Inflation does not affect everybody equally. A person who depends primarily on a paycheck needs wages to increase at least as quickly as the cost of living. If someone's income rises 3%, but their actual expenses rise 6%, that person is losing purchasing power, even though their salary is technically higher. Asset owners have another source of protection. Businesses can raise prices. Real estate can produce higher rents. Stocks represent companies capable of growing revenues. Gold can rise as confidence in currency purchasing power falls. Farmland produces food. Other productive assets generate income or provide something people continue to need. That does not mean every asset automatically beats inflation. Stocks can crash. Real estate can decline. Businesses can fail. Gold can suffer brutal corrections. But assets have the ability to reprice. Cash and wages often adjust much more slowly. That difference is one of the main reasons inflation can widen the wealth gap. Someone who owns $1 million worth of productive assets may see the nominal value of those assets rise significantly during an inflationary period. Someone with no assets may receive a modest pay raise while watching housing, food, insurance, and investments become increasingly expensive. Both people are experiencing the same inflation. The outcome is completely different. This is also why official inflation statistics matter so much. The way inflation is measured has changed over time. Housing is one example. Modern inflation indexes do not simply take the current price of homes and place that number directly into CPI. Housing costs are captured largely through rent measurements and owner's equivalent rent. That means home prices themselves can rise dramatically without showing up one for one in the official inflation number. For someone who already owns a house, rising home prices may increase wealth. For someone trying to buy their first house, that exact same increase makes life more expensive. Official inflation may say prices rose only a few percent, while the asset that person is trying to purchase increased much faster. That creates a disconnect between reported inflation and lived inflation. And if the next several years bring larger deficits, persistent inflation, higher debt, and increasingly accommodative monetary policy, that disconnect could become even more important. The number on a paycheck may continue rising. The number in a bank account may continue rising. But those numbers are meaningless without purchasing power. Real wealth is determined by what that money can actually buy. That is why asset ownership becomes so important in this environment. The larger argument is not that everyone should suddenly put all of their money into gold, stocks, or real estate. It is that relying exclusively on wages and cash creates a major vulnerability when the monetary system itself is under pressure. Productive and scarce assets provide another source of wealth creation. They give people something that can potentially adjust as the currency loses purchasing power. And if the government's debt burden continues growing while the Federal Reserve becomes increasingly constrained by fiscal realities, the divide between asset owners and wage earners could become even larger. The people who already own businesses, stocks, real estate, precious metals, and other productive assets have something capable of appreciating. The people who depend entirely on their next paycheck do not. The biggest financial risk may not simply be whether the Fed raises or lowers interest rates at its next meeting. The bigger risk is what happens when government debt becomes so large that every monetary policy decision has to consider whether the country can afford the interest bill. At that point, protecting the currency and protecting the financial system may no longer point in the same direction. And if policymakers ultimately choose to protect the system by allowing more inflation, the people who own assets will be in a very different position from the people who do not.